The stock market news impacts the market in a big way. There was this great comment on the China stock rally how the media narrative follows the stock price. In January, Alibaba was low, the news was abysmal, now it's suddenly great, then this week again bad of the stock prices correcting slightly. And I really want to go through the news a little bit to see how that impacts our investing. They just chase prices like headless chicken. Augustus here has been investing just for 3.5 years, but ignorance is reinforced by the financial media ecosystem that claims to be informative, and therefore we must check that so that you don't fall into the financial media ecosystem trap. Let's just check this. I just went, after reading this comment, to Bloomberg to see the markets, US edition, and what is the key there. Fed cut decision on solid data, so again, something short-term, traders see 20% chance of half-point ECB rate cut in December. Keep in mind, before the Fed's 0.5 cut in September, traders were seeing 0% chances of any cuts in September. So irrelevant. Fed stuck on 6 weeks data cycle forecast because so they can gamble in the market what the Fed is doing, not the fundamentals. Just on the Asian side of parts, China moves to support market after data showing economy slowed, and this is something very important when it comes to the economy and China and how the financial media is working on it. This was from September 10, just before the Chinese rally started. And look at the headline. China's 6.5 trillion stock rout worsens economic peril for Xi. Bad situation in China, and then stock is exacerbating the crisis of confidence in the world's second largest economy, heaping pressure on policymakers to halt the downward spiral. And look at the Chinese effort to boost stocks. Chinese don't go for boosting stocks, they go for boosting the economy, which is something very important. And then look at how the news describes the market. Boosting markets, okay, something goes up, stamp duty cut, quant trading, short selling restrictions, buying ETFs, some jumps, but negative, guidelines, okay, more curbs on sales, but the market simply went down in this period, and it has been an amazingly bad day for markets. This is still before the rally from September. The problem is the economy in a worse place than I thought 6 months ago, says someone. The longer the government refuses to create any demand, it will be harder to resolve persisting damage. The market underperforming everybody else in the world looks terrible, and we have seen a few rebounds, but that flopped in a matter as the grim economic reality hit home. Grim economic reality is growth of 4.8% compared to the expected 5%. Let me remind you that real economic growth in the West is zero. So where is the grim? Just a reminder, just to discuss. And investors are disappointed, feeling hopeless. And look at this. They are cutting down their already low exposure. Everyone is going away. Only way out is government liquidity, quantitative easing. Latest economic data has intensified such concerns. China may miss its economic growth goal of about 5%. Really terrible things. And then something changes. Okay, stimulus, economy, trying to stimulate, okay, and then suddenly everything booms, rally extends, breaking news for China, everything is boom, bada bim, stocks go up like rockets, stimulus packages, really exciting, everything is rallying, this time might be different, urgency, nothing like this has happened, let's push it, everyone is saying this will just continue growing, greed is coming to the market, and then after the 40% rally, suddenly people are starting to sell, and then we go back again to the negative. 17 October 2024, China ETF is the biggest wealth destroyers in the US. The record is that there were 5 billion assets less than the inflows, and those traded funds rallied at times, but that's just it, short-term trading opportunities. And the erosion of asset values for US, they are trading vehicles rather than investing vehicles. And you can see here how ARK had inflows of 13 billion, assets of 5.6, destruction 8 billion, 12 billion of inflows, 7 billion of assets, so destruction of 4.6. But I think here someone then says at the end of the article, it is about timing. And I think this is the key. Investors. What investors? 99% of the market is just gamblers. So maybe the financial media should call 99% of people gamblers, not investors. This is a key differentiation factor. And then Chinese stocks trade like ARK. And I'm reading these news, and I'm reading this news last decade here, and nobody mentions fundamentals. Then something I find finally, 12-month earnings of the MSCI China index, and you see, okay, earnings are down on 12 years. What's going on, Sven? There. Then I check the holdings. Tencent earnings are up 5 times, 4 or 5 times. Alibaba, a lot of equity, but over 10 years also up 10 times. Meituan, growth stock, okay, let's say that is flat, but we round the circle and nobody is focusing on earnings, not even the clients. And that is why the financial media caters to 99% of the population, because they don't care about earnings, they care about news, they want to see the stock's price going up and down. Only we here care about fundamentals. It is hard, but I'm just looking at Bloomberg and everything from the side and getting a good laugh about it. We bought China Mobile a few years ago. The dividend has been growing. Now it's 6.7. It was 8%, plus 5, 6, 7% growth. And that is 10%, 15 of the portfolio and doing well. And I'll keep and reinvest the dividends just on those fundamentals. I know it's hard, but we'll just keep watching the fundamentals, enjoying the craziness surrounding the markets, buying the fundamentals at the fair price. And if you like that, subscribe for more.